'Cause I can't lose. 'Cause I can't lose. 'Cause I can't lose. Yo.
You keep saying that we're going to be spending money like this, but, you know, some of our analysts have been pointing out $700 billion is actually just 1% of our GDP. Our debt is lower than other OECD countries. It seems like a small price to pay for salvaging our economy and our future.
Well, I don't think it will. I think it makes it worse. I think we're doing what we did in the Depression. We're trying to prop up bad debt. Housing prices should come down. We shouldn't prop them up. And if assets are illiquid, that means they're usually worthless, and they need to be wiped off the books. And instead of allowing this to happen over a 3, 4, 5, 6-year period, you should do that in 6 months, and then we can go back to work again. It's sort of like propping up the stock market instead of allowing it to go down and start all over again. No, I think this is interference in the marketplace. It's the furthest thing from the free market. It's propping up bad debt with more spending, more debt, and more inflation. My big concern has been that everything we've done for 35 years, we've papered it over with inflation. As long as you can create new money, you create more inflation, and that's what we're in for, the devaluation of the dollar.
You can't predict exactly when these kinds of events happen. Yes, I actually did think it would be happening, I'd say roughly around now. And basically what's been happening is the cumulative effects. House prices have continued to fall. That means more defaults. That means more financial institutions are in deep problems. You know, you can paper things over for a while, but eventually you have to face reality.
We're speaking with Joseph Stiglitz. He is a Nobel Prize winner. In fact, he's been involved in several Nobel Prizes. Here, if I read his bio correctly, we bring you the economists who have been right. We don't bring you the economist who's been wrong, the ones they like to put on TV all the time, though you're on television sometimes, but it's about 90% disinfo, in my opinion. You were getting into the red flags you saw years ago and then going into this war and why you've been ringing the alarm bells about really serious financial problems. So please continue.
Well, what I was saying is that there are several things, both about the war and the way that it was financed, that should have been a cause of concern. This was a war of choice. This is a preemptive war. This is a war that as we went to war, we had a huge deficit, and yet the president asked for a tax cut. You know, usually when you go to war, you ask your young men and women to go risk their lives, and then there's a sense of shared sacrifice. And the only sacrifice the president asked was for people to go down to shopping malls. And there was actually a tax cut for upper-income Americans. Well, the piling up of debt has meant that should a problem occur, and a problem has now occurred, there would be less room for maneuver. We wouldn't be able to do anything. When we had an economic downturn back in 2001, we had a surplus of 2% of GDP, and that gave us a lot of ammunition to use to try to remedy the problem. Now, next year, we're expected to have the largest deficit in America's history. In 1 year, hitting $500 billion. Now, that's one problem. The second problem was that the war is, in my judgment, largely responsible for the increase in the price of oil. It was back in 2003. It was $23, $25 a barrel. Futures markets understood that there was going to be increases in demand from China, from other places, but they believed that there would be a concomitant increase in supply from the Middle East. The war changed that equation, and now we have oil $100 a gallon. Now, normally, if a country is spending so much more money abroad, as we were importing oil from Kuwait, from Saudi Arabia, from other countries, it's going to weaken the economy. But it didn't seem to be happening. And why? Well, some people said there was new laws of economics. Whenever anybody says that to me, I start getting suspicious. What was going on was very simple. The Fed decided to let forth a flood of liquidity, lax regulation. We got a housing bubble. The housing bubble led to a consumption boom. Savings in the United States went down to zero. It sustained the economy for a while, but we were living on borrowed money and borrowed time, and it was just a matter of time before something happened. And so when I looked at what was going on, how the economy continued in spite of the high oil prices, in spite of the war, it was clear to me, and I saw the housing bubble, and I saw what was happening to savings rate. It was, you didn't have to be a genius to say that there were problems around the corner.
And of course, the housing bubble made everybody think that they were rich. And so as people were extracting equity from their homes and buying cars and SUVs and cell phones and plasma TVs, they didn't really think they were borrowing the money. They actually thought they were rich. They thought they had all this home equity that they were tapping into. But the reality was the home equity never really existed. All they were doing was borrowing money, secured by, the illusion of home equity.
Secured by inflation.
Well, it was, the inflation is what was putting the money into circulation, and eventually the inflation started to cause prices to rise other than real estate, such as food, such as energy, and of course the government blamed that on external factors, but of course it was a direct result of their monetary policy, but then we also have a tax code that incentivizes borrowing. We give people deductions for their mortgage interest, yet we tax people if they earn any interest. And we had all kinds of incentives to buy and flip houses with tax breaks. If you buy a house and sell it at a profit, you pay no taxes. But if you buy another asset and sell it at a profit, you pay taxes. And if you actually work for a living and earn wages, you pay a lot of taxes. So the government made it more lucrative to flip property than have a job, and they provided the cheap money. They also provided the market with Freddie and Fannie, which are these giant government-sponsored enterprises, which by guaranteeing all the mortgages made it possible for people to borrow much more money than they can repay because the lenders didn't care about the default risk because the government was guaranteeing the mortgages. So you had that moral hazard, and so you had this huge bubble. But the whole thing is blown apart. But
we'll talk about the other areas. I mean, we have the mortgages, but we also have all the other types of derivatives and the insuring of them.
Well, the bottom line with all these derivatives is the underlying assets are liabilities that nobody can pay, whether they're mortgage debt or credit card debt or student loans or automobile loans. Basically, the one thing that we were creating in this country was liabilities. And then Wall Street would package these liabilities and make all sorts of securities out of them. And so our whole economy was about incurring debt and securitizing and restructuring debt. It was all phony. It was all a facade. And, of course, but all this paper wealth enabled us to spend a lot of money. But the money we were spending was being loaned to us by the Chinese, by the Japanese, by the Saudis, and all the things that we were spending the money on were being produced in China and Japan and other parts of the world. And so we were basically living off the charity and the productivity of the rest of the world, and it was destined to end because the world's not going to support us forever.
Yeah, the thing about a derivative, if you think about it, you got to go back to, remember, the dot-com craze of the late 90s. A lot of these dot-com companies did what was called banner swapping, where Company A and Company B would swap, let's say, $1 million worth of banners. These banners had no intrinsic value at all. But both companies would book the transaction as a short-term gain, and both companies would book the long-term the loss as a long-term liability. If you think about that in terms of what the banks have been doing for the past 5 to 10 years, it's kind of a sophisticated version of this banner swapping, where Bank A and Bank B, they'll both swap $1 billion worth of derivatives. These derivatives have no intrinsic value whatsoever, but both Bank A and Bank B will book the immediate sales of profit. That'll drop down to the bottom line. That'll boost the stock price, which will trigger an option payment to the executive. And both banks will consider the loss as a long-term liability that they don't have to worry about for 10, 20, 30 years. Now, what happened, that's just, if you look at it in that context, you understand that what's been going on is just billions, hundreds of billions, and trillions of dollars worth of what are intrinsically, inherently worthless transactions, but they generate these huge amounts of fees for the people involved. And for 10 or 15 years, they could get away with it because for 10 or 15 years, really going all the way back to the early 1980s, the trend in the markets, in the bond markets specifically, has been one where interest rates have been, for the most part, going down. So this has covered up a lot of sins. But what happened last summer, Alex, and the reason why this crisis really hit was that starting last summer, you had this long-term trend in interest rates reversed itself, and interest rates started to tick up. And what happened was the hologram, that is this global financial system, started to be shut off. And these banks started to have to realize that what they were carrying, they had to come clean and say, look, this doesn't actually have any value whatsoever. Effectively, it has become a financial black hole. You could shovel $700 billion, $1 trillion, $3 trillion. It won't make any difference. The structural integrity is going to collapse.
Well, now it's in the Army Times telling you how great it is and saying the Army says they hope they don't have to shoot you. Just hand over the pension fund or things will get rough. We'll be right back. Stay with us.